just because a comp is there doesn't mean that someone's willing to pay that much for your house. A comp, a comparable value of a property that just sold, just says, hey, someone did buy it for this much that's similar to yours, so maybe you should try and get the same, essentially is what that's saying. But if you list it for the same and you go to market and the market doesn't want to pay that much for it, it means that your house or your property or your commercial real estate asset is not worth that much. So AI and data and computers aren't necessarily in tune with the investment decisions that are happening behind the scenes and in the market. Hey everybody, welcome back to the Real Entrepreneur Podcast. My name's Alex Coffman, your host. Thank you for tuning into this every single week. For those of you who attended the live commercial real estate training last night, hope you got a lot out of it. And for those who took advantage of the offer that we made where you can get access to the commercial real estate investing essentials courses for only $99 a month. We typically sell that thing for almost 10 grand, but you're getting it for only $97 a month. I said 99 a minute ago, but it's $97 a month. And you get a ticket to the One Deal Away Bootcamp, where in about 20 days, 15 days, we're going to spend 3 to 4 full days together, depending on if you have VIP or general admission ticket, securing a deal for you that will help you accomplish your goals. By the end of the 3 to 4 days, you're going to have made an offer on a deal that hopefully will change your life. So congratulations to everybody who took advantage of that. For those who didn't, we're still selling it right now. It's only available for a few more days. You can take advantage of it. The link is in the description. But today what we're going to do is we're going to go through some hot topics, some hot takes on commercial real estate. Kat's going to read me some headlines, and we're going to see what's happening in the commercial real estate world right now.
So this one's on investmentnews.com. It talks about Blackstone REIT in the media crosses hairs over the valuation. So there's sketchy math dogs, private market investments sold to retail investors. What's your hot take on that?
So the actual headline is Blackstone REIT in media crosshairs over valuation. Not cross its hairs. They're in there crossing their hairs. But I mean, I'm not sure, specifically what this article is talking about. If you could scroll down, I could look at it. However, that's the problem with valuing these assets right now is how are you going to value them? I mean, commercial real estate is valued based on the cap rate and the income that it produces typically. However, there's also, land and improvement values. And right now, values are kind of all jacked up, right? Like interest rates are high, so you can only pay a certain amount for deals with debt. You can pay cash for deals, but the market values these assets. So, of course, Blackstone is not going to, try and undervalue these assets. And I would say that, the media, who's never bought, $15 billion worth of real estate, such as this BREIT, probably has no idea what they're talking about when it comes to valuing real estate. Sure, they can do a simple math formula, but Blackstone and the people who are actually doing deals are tuned into the market and what people are willing to pay. And Blackstone's not going to want to undervalue their assets. But I'd also say that the media has no idea what they're talking about as well when it comes to actually buying and owning real estate investment properties such as Blackstone. So, I don't know what's happening here, but maybe Blackstone, is overvaluing their assets and the media is saying that they're not worth what Blackstone is saying. However, in 8 months, it could be worth 35% more than Blackstone is saying right now. The market is in a weird spot where interest rates are remaining high, and depending on what type of asset it is and where it is, the value is based on what somebody be willing to pay for it today, and not necessarily, what formula you would use 3 years ago. So I don't know. I'd be curious to see what happens here. The math, this is what it says. The math behind non-traded real estate investment trusts has always been vexing. That's why this product needs to be regarded with the utmost caution by financial advisors and their clients. Fast forward to spring 24, investors have pulled more than $15 billion from the REIT and the company's net asset value does not appear to be feeling the woes of the broad downturn in commercial real estate. Just as interest rates began to rise, the REIT reported net asset value of $14.53 per share in January 22. That increased 8 cents per share by last October, the same period where the S&P declined 35%. The REIT's valuation was $14.15 per share in February. So they're just valuing it based on the dollar per share with the REIT. Our process, this is from Blackstone. Our process requires us to use monthly property valuations that have been assured by a third party. We have never overridden these in the REIT's history. So, real estate is not, that's the tricky thing about real estate and shares and looking at it on a daily basis is real estate is not necessarily liquid, right? The REIT makes it liquid. And when you have to provide a value to something on a daily or monthly basis, in this case, it becomes a little difficult, There's a lot of things that affect it, and ultimately the real estate is, valued based on what somebody would be willing to pay for it. And there's nobody more in tune than Blackstone. Definitely not who wrote this article. So I'm not defending Blackstone. I guarantee that Bruce Kelly, who might just be reporting on the thing here and not saying that Blackstone is lying, but I guarantee that Bruce Kelly has less market information and is less in tune with real estate assets than Blackstone. But not defending Blackstone. However, of course they don't want to undervalue their real estate and make the REIT shares fall.
All right, so this next article is from MoneyWise. This is from Tom Ellsworth. He says a crisis is about to happen. $929 billion in commercial real estate debt is about to come due. Will America's regional banks survive the storm?
Yeah, this is nothing new. You guys all know this. We've been talking about this. I actually watched this clip. This is on Patrick Bet-David's podcast, he and his team. And nothing's changed. Interest rates are still high. Everybody, it's what we just talked about. People, all these sellers and everybody were waiting for interest rates to lower. They overpaid for their assets in 2020, 21, 22 when interest rates were at historic lows. Now they're not. Now the real estate's not worth as much as they paid for it. Their short-term debt is coming due. Banks can't refinance it. They can't sell it at prices that they want to. Investment firms, private equity groups, big institutions are selling their deals at 50% losses. One sold it at a 97% loss. I mean, these people are selling their assets at losses because they have to. And going back to the second piece of that, will America's regional banks survive the storm? We just had a bank go under a couple weeks ago. I forget the name. Last year, there were 2 banks that flopped. And if these banks aren't set up correctly, and I don't know the infrastructure of these banks or, exactly what goes on there, but if they don't have the cash and they took, too much risks and, now the debt that's maturing, they can't call due. If the government allows it to happen and if the government allows the free market to do its thing, then yeah, there's probably a lot of banks that could and should go under here soon. But, government doesn't want a run on the banks. A lot of these things are FDIC insured. And also when they get put in those situations, then a big whale just comes in and swallows them up and takes over the bank and everything that they had going on. So the commercial real estate debt is a problem right now while interest rates are high. And this is your opportunity to go out there and steal some deals. This is what we've been saying and everybody's been saying for the last 18 months. It's still here and it will remain here so long as interest rates remain at the level that they're at. The moment that rates start declining is the moment that this goes away because people can refinance out of their debt and get into better longer term debt. Hopefully, depending upon, where their values are at, but the lower rates will help out tremendously. And also the values will increase once the debt decreases. So it'll be here so long as the interest rates stay where they're at. And I would be very curious to see if any banks go under here soon, because chaos in the market means opportunity. And this could be your once in a lifetime opportunity to go out and steal some deals that you wouldn't otherwise be able to get.
All right, moving forward with Go Baking Rates with Yahoo Finance. So Barbara Corcoran, she says these are the 3 cities to invest in real estate now before prices skyrocket. And those cities that she recommends is Pittsburgh, Pennsylvania, Columbus, Ohio, and Indianapolis.
They have a young, educated population with lots of job growth and big companies in the area. Pittsburgh is average home value is $227. Up 6.2%, 88 colleges. Ohio, average home value $243, and Indianapolis $224. Yeah, Barbara is very smart. I've always said that every Barbara I've ever known is a shark, and they're straight shooters. I'm sure there's the exception out there, but Barbara's really smart, owns a lot of real estate, owns a lot of businesses, and I would say if she says this, then to trust her. We are looking in Ohio. We're not looking in Pittsburgh necessarily, and we're not looking in Indianapolis necessarily. But I'll start looking into these markets a little bit more. But go back up to, she was saying, I'm investing heavily in places like Pittsburgh, Columbus, and Indianapolis. They have a young, educated population with lots of job growth and big companies in the area. I mean, that's what you're looking for with real estate, is a good location with increasing population, with lots of job growth and big companies. And, the more job growth, the more demand, higher the prices, and the more an area is going to grow. So those are important factors, but there's also other important factors depending on what you're investing in, which she didn't mention here if she's buying multifamily, industrial, retail. However, all of that should benefit. But in a place like Austin, with apartment inventory, there's a lot of stuff that, has come to the market, and there might not be enough demand to absorb all that inventory that's coming. So what that will do is it'll create, more vacancy in the interim or slower rent growth, because there's, more supply for apartments than there is demand. And so you have to take into consideration things like that as well. But I would say that I would trust Barbara and what she says here, and you should look into these areas.
All right, our next article, also from MoneyWise. This is the headline: They are awful. Dave Ramsey is fed up with millennials and Gen Z, who he claims don't work but want to own homes. Here's what he says you need to be a successful investor.
They live in their mother's basement and can't figure out why they can't buy a house because they don't work. Well, I would agree with Dave Ramsey. I'm fed up with it too. I've been fed up with it for a long time. They're awful. Dave Ramsey is fed up with millennials and Gen Z, who he claims don't work but want to own homes. Yeah, I mean, it makes no sense. I would agree with Dave Ramsey. If you're not working, you don't create an income, you live in your mother's basement, but you want to own a $500,000 house and collect butterflies, and draw paintings and without getting paid for fun, and expect to live a stress-free, perfect life and have everything handed to you. But you want all these things that cost money and are not going to be handed to you, then I would say that these people are delusional.
So our next headline is from Urban Land: Artificial Intelligence Bad Data Problem from Real Estate Investment. So this talks about, with all the hype of AI in the real estate industry, there's a huge problem with too much bad data.
Yeah, I would agree with that. I don't know specifically what they're talking about here, but there's a ton of these, AI companies and real estate AI companies. And to be honest, I think a lot of the AI that I've experienced is kind of stupid. Maybe I'm the stupid one and don't know how to use it, but it doesn't seem that smart, some of it. And real estate is not just I don't know what this bad data is or this artificial intelligence bad data is, but as a real estate brokerage and other things, we get emails all day long from these AI companies who, have the next solution for for real estate. But real estate investing and negotiations and working deals, there's more to it than whatever the data is. And that's kind of what I was talking about with the Blackstone valuation is most of this data isn't readily available, right? And real estate on the investment side transacts, and on the consumer side transacts based on what somebody's willing to pay for it. So it's not even necessarily based on the comps, just because a comp is there doesn't mean that someone's willing to pay that much for your house. A comparable value of a property that just sold just says, hey, someone did buy it for this much that's similar to yours, so maybe you should try and get the same, essentially is what that's saying. But if you list it for the same and you go to market and the market doesn't want to pay that much for it, it means that your house or your property or your commercial real estate asset is not worth that much. So AI and data and computers aren't necessarily in tune with the investment decisions that are happening behind the scenes and in the market that somebody else might be aware of due to their relationships and connections and inside information. So also too, just because a math formula works doesn't mean that it's a good deal. There's a ton of factors that play into deals: location, management, operations, the market condition, what somebody else will pay for it, what type of debt you're able to get. And until there's an AI or computer software program that can figure all that stuff out and problem solve and pull together data that isn't available online by other probably, unqualified data sources, then I would say that I would not trust it. And also too, just because the data says you should pay this price for it doesn't mean that you can't go in and offer 30% below that and it get accepted. There's personal things going on. There's so many factors that play into a deal and what price is landed on a deal and the terms and everything that's structured within a deal. And I'm not positive that, at least currently, that AI is able to figure it out.
All right, switching to more local news. This was just released, I think, yesterday. Let me see. Yesterday at 1:57 from the Taylor Press. So as we know, there's a lot of development happening in Taylor. But this headline reads, the University of Texas at Austin to create a Taylor location.
Yeah, pretty cool. Big for the city of Taylor, big for Round Rock, big for Hutto, big for all Austin suburbs. Hopefully good for University of Texas. When they say Taylor location, are they talking about like UT Tyler, UT? Oh, really? That's pretty cool. UT Taylor. Interesting. I would feel like maybe this location specializes in something because UT is not that far from Taylor. So I would assume you would just go to UT versus UT Taylor. But like UT San Antonio makes sense. UTSA, it's, further away. I don't know. I'm not I don't know how they're going to do it, but it's big for Taylor, big for everything here, and it's great. Good for the economy. I don't really care about college, and so I don't really know the significance of it other than it's going to be really big for Taylor, and Taylor's growing like crazy. And for everything surrounding Taylor, and for the, east of Taylor as well, right? Like so far, everything east of Taylor really hasn't reached where it should necessarily. It's always been too far on the outskirts of Austin, but now it's going to have to expand much further east and north of Taylor a little bit. All right, well, that was fun. All right, so that was it. Thank you guys for tuning in today, and we'll be back next week. If you're interested, again, like I mentioned, that offer from last night's live commercial training, $97 a month for all 6 commercial real estate investing essentials courses. Monthly subscription, you can cancel at any time. Only $97 a month. We sell it for like $10,000, so you're getting it dirt cheap for free. and you can cancel at any time. You also are going to get a ticket to the One Deal Away Bootcamp, June 4th through June 7th. I'm going to be spending these days with you, teaching you how to find, analyze, locate, structure, negotiate, underwrite, and send an offer on a deal that will change your life. So I hope to see you there, and I'll see you next week.